As we say, mistakes are the seeds from which trees of knowledge grow. US banking crisis provides such seed from which you and me can learn, grow our knowledge to better with our money. In this video, I'm going to share 5 money lessons that I learned from US banking crisis which could be beneficial for you. How does the bank actually work? So bank basically takes deposits from people like you and me, and then they lend that money for a margin to either people like you, me as a loan, or for a business for their business loans, as a mortgage to real estate, or they sell like various financial products and insurance where they make more margin as a profit. Bank does hold some sort of reserve for emergency. Now, in particular in US, only big banks are currently regulated to have a money reserve to ensure they are liquid. So what is this? So basically, you can see here, like I'm talking about the 50 billion threshold. So any bank that has a 50 billion in deposit or more, then they are stipulated by Dodd-Frank Act. So as part of this Dodd-Frank, bank with more than 50 billion assets would be subjected to more rules, such as, they have to go through stress test, capital planning to ensure bank holds enough capital to survive a crisis, liquidity requirement. This is what I'm talking about, reserves. So they have to, each bank, so if they have more than 50 billion in assets, they have to ensure that banks are sufficiently liquid if they lose access to funding, which was the case with SVB and Signature Banks and Silvergate. They didn't have enough liquidity, so therefore they went bust. But keep in mind, this is Dodd-Frank says the bank that has more than 50 billion as asset. 2018, there was an Economic Growth Regulatory Relief and Consumer Protection Act that was signed, which significantly changed that requirement of this Dodd-Frank Act. Basically, instead of setting the threshold at 50 billion, now this 2018 Act has increased that to 250 billion. Banks like SVBF, Silvergate and Signature Bank did not fall under these rule anymore. Now, if 2018 Economic Growth Regulatory Relief and Consumer Protection Act was a mistake, that I leave it to US government and regulators to deal with. Okay, now that you understood how the banking system actually works, now I want to talk about this banking crisis overview, meaning like how large of a failure these two banks compared to other bank failure in the US history. So first off, since 1998, as you can see in this chart, clearly Silicon Valley Bank and Signature Bank are top 2 and 3 of the largest bank failure by total assets, as you can see here, and the first being the Washington Mutual Bank, which collapsed in 2008. And if you can see the rest of the banks, mostly they collapsed during that financial crisis of 2008-2009. So what did actually happen to SVB? So if you can see SVB as similar to any bank, they had deposits mostly from US high-tech ventures, okay? And then these deposits grew significantly from 2019 to 2022. Now, SVB was investing most of these deposits into the bonds issued by the US Treasury, because they were usually which usually provides low return / risk, and they only held small amount of those deposits into cash. You can already see the problem. They didn't have a lot of cash reserve to avoid any crisis. So, so as they were doing all of this, on the other end, as you know, in 2021, the inflation was really going high. So the Federal Reserve increased the interest rates in response to the high inflation, and the Silicon Valley Bank bonds become a riskier investment because, as you know, investor could buy the same very bond at high interest rates, and Silicon Valley's bond declined in value. Okay, so as this was happening, some of the Silicon Valley Bank customers, many of whom are in the technology industry, as you can see, the depositors are already in high tech ventures, so they hit with the financial trouble. So therefore, what they did, they started withdrawing large funds from their account. So to accommodate that withdrawal, Silicon Valley had to decided to sell some of its investment in these bonds. So therefore, they lost almost like 1.8 billion. And you can imagine. So that's why they had to sell off all these bonds, and that marked actually the beginning of the end of the SVB Bank. Talk to you about the FDIC role. So FDIC usually protects any deposit that is less than or equal to 250K. Okay, I will get to why I'm talking about FDIC shortly, but you have to keep this in mind. Now, as this SVB saga, as SVB run into the bank run, most of the people out there got spooked by it, so they started withdrawing money from Signature Bank. So basically, they withdraw large sum of money from the Signature Bank. So soon, Signature Bank was in similar situation as SVB and was shut down by the federal regulators on Sunday, March 12th, 2023. So, and the Signature Bank stock price plummeted. So, and that's the end of SVB and the Signature Bank. Now you understood what happened to SVB and Signature Bank. Time to understand what happened to Silvergate. So, Silvergate evolved from a small business banking firm into a publicly traded company. So it is listed, and it pivoted to providing services to major cryptocurrencies such as FTX. You guys remember FTX, Coinbase, and Gemini. These are some of these famous exchanges, right? And all of which are currently under target investigations. So you also recall earlier this year when FTX to get collapsed, it caused crisis within Silvergate because they held large deposit. So therefore, as this was happening, people's attention, and they were spooked by this because FTX collapse was big thing. They were into fraud. So naturally, people panicked and they were not sure if their money are safe. So lot of crypto companies and whatnot, they started withdrawing large sum of funds, almost like $8.1 billion. To service that withdrawal, they have to sell lot of derivatives and stocks at $1 million in loss. So you can imagine that marked basically the end of Silvergate. Now let's dive into the money lesson. So the first thing is, I want to bring it to your attention, this tweet from Genevieve CFA. In this tweet, she brings a list of top 100 bank in US with deposit less than 250K as percentage of their total deposit. Now, according to this list and her tweet, as you can see here clearly, SVB, which sits in 99th of the top 100, only had 2.7% of total deposit that were less than 250K. Meaning, rest 97.3% was not insured by FDIC. If you recall, I mentioned earlier that FDIC only protects deposit less than or equal to 250K. Now, even though this tweet is talking about like how 97.3% of the deposit of SVB was not insured, but at the time of recording, Federal Reserve and Treasury already bailed out SVB, and basically they told the depositors that all of their money would be coming back to them sooner or later. But now it is also important to understand other big players that are in this list, because this will have a ramification later down the line. Now, at the time of recording, the market is still digesting all this information. So the contagion fear is still, Federal Reserve and Treasury is still trying to assure these bank runs by providing the confidence to the depositor that I'm going to bail out. But we don't know the contagions of this entire banking crisis, right? Which is still something is people are analyzing and trying to understand it a bit more. Now, coming back to this list again, as you can see, JP Morgan, which is in the 75th list, which only had 32% of their total deposit less than 250K, and Bank of America only had 30%, right? Now, it is alarming to know that Citibank, it's one of the largest bank, only had 15% of their total deposit less than 250K. So it's only time will tell how this banking crisis is going to unfold. But rest assured, Federal Reserve and US government and Treasury are going to come with more regulation for the banking sector. So what is the takeaway from all of this? So the takeaway from all of this is, do not hold more money than what FDIC or CDIC, because I'm from Canada, so CDIC can protect your bank deposits from. So what does that mean? So for example, FDIC, which is US, they cover almost like 250K or less. If you hold a deposit of 250K or less, for each account, they have various account, and they clearly specify what is the coverage amount, and they pretty much across all those accounts, they cover almost 250K or less. Whereas in CDIC case, they only cover up to 100K. Now, they also, there is something subtle information there that you can go and read up in CDIC for more clarity. But I just want to bring it to your attention that CDIC clearly say in their website, in the event of a member institution failure, a depositor checking account, saving account, and any unregistered term deposit in a single name would be considered as deposit held in one name and would therefore be combined. That's the important message, therefore be combined. My interpretation of this is, let's say if you have a GIC, term deposit, savings account, and checking account with a financial institution, within the same financial institution, the sum, everything together, they will only cover up to 100K. It's not like for each account they will cover 100K. It's combined. So therefore, I will leave it. Please comment if my understanding is wrong, but that's my understanding based on what it says in CDIC website. So just to summarize, do not hold more money than what is protected for each of your deposit in each of the financial institution. Okay, the money lesson 2. I want to bring it to your attention how large trading brokerage firm can go to bankruptcy. So you can see these are the tweets from SVC Securities, one of the brokerage firm from UK, and these tweets are from 2019, where they're asking for customer to open an account, or like how they are low cost, stock brokering services in UK. Okay. Now fast forward to 25th November 2019, SV Securities was placed in special administration by its director on 5th August 2019. Basically, they stopped SVC from conducting regulated activities and restricting it from depositing of assets. Why? because they had a serious concern about the way the business was operating. As a result, the director obtained solvency advice, solvency advice and resolved to place the firm into special administration. So, long story short, this company went bust because of its, some funky operations. So please understand, your account are not, so if you have an investment account, they are not typically protect. If you are in US or in Canada, they are not typically protected by FDIC or CDIC. That's first thing you need to understand. Their protections are varied. So for example, if you are in Canada, your investment accounts are typically protected by CIPF, which stands for Canadian Investor Protection Fund. So according to them, they protects 1 million in coverage for the investment accounts, right? SIPC protection, according to their website, is 500,000. So whereas in Canada it's 1 million, so I'm proud in Canada they protect more. Basically what I'm saying is, do not hold, in my view at least, do not hold more money than the protection provided by CIPF or SIPC. Okay, the money lesson 3. You saw SVB, Signature Bank and Silvergate. In my view, they could have avoided a bank run if they had a diversified clientele. What does that mean? So for example, when we saw SVB, they only had venture depositors, right? Let's say if they had different types of customers, perhaps they could have avoided. Similarly with Silvergate, they were focused on only crypto type of clientele, right? Same thing with Signature Bank. They were having only crypto type of clients, right? So what is the takeaway from this? This is like, as an investor like you and me, is a very important lesson is that, like, when we invest, it is important that you diversify your investment as much as possible. For example, you can buy a simple index fund. By having just an index fund, for example, if you buy S&P 500, you're already kind of diversifying into 500 different companies. Money lesson 4 is, the crypto investments are sometimes protected by private insurance, but are not covered by FDIC, CDIC, CIPF, and SPIC insurance. So, for example, lot of these crypto companies like Celsius, BlockFi, FTX, Voyager, they all went for bankruptcy recently. You know how various customers who held their account with them went scrambling for their money. There is a lesson to be learned. We need to understand there is no protection for these crypto companies in general. Sometimes, for example, crypto.com app, in their website, they say an insurance protection of almost US 100 million. I don't really believe on these private insurance, as I said earlier. If you believe it, please comment on below. So, and moreover, on the top of it, crypto investments in general are not regulated. There are many discussion around this in terms of how crypto should be regulated. See, as an investor, you should be careful. Okay, the last but not least, the money lesson 5 is, it is important to have some liquid cash with you as an emergency fund. Okay, so in my view, the SVB, Signature Bank, Silvergate could have avoided the bank run if they had, more liquidity, if they had enough cash reserves. Now, so that's the takeaway. So we often overlook, because we always think that, why do we need to have these cash in our checking account or savings account? Because it's kind of collecting dust. Inflation is eating up. So why bother, right? But it is important to understand from these crises, shit happens, okay? And you and me, as a normal human being, we can only predict so much. And I don't think so anyone, you cannot really predict the outcome of like what is going to happen in the future. Therefore, it is okay to keep some sort of a liquid cash in your emergency fund. Now, if you think otherwise, please comment again. Okay.